Alright everyone, so in this video I want to show you guys the biggest mistake that new options traders make. I see it all the time again, and it totally makes sense that this mistake keeps on happening because it is based on greed. It is the feeling that you finally figured it out. For example, you started trading the premium cycle, so you are selling cash secured puts on very conservative stocks like this one, for example, Procter & Gamble. I just uploaded the video about this, so make sure to check out this video. So what basically happens is I see traders trading the premium cycle on conservative stocks. You see a good setup, you sell a cash secured put on a stock like this one, and you never end up being assigned, or possibly you are assigned 100 shares, but the stock is kind of like trading around that price level where you bought it, and you sell your covered calls. It is quite successful for you, and your confidence is just skyrocketing. So you think you figured it out, and your plan that you had, it worked out. For example, you saw a support level on a stock like right here at $135, and you think you figured it out, and your confidence skyrockets. You're basically becoming overconfident. And what happens then is the greed. The greed comes into your life, and you find different stocks like this one, for example, Navitas. I saw many investors or options sellers get absolutely smashed on this stock because you get an illusion here. You look at a stock like this one and you see that stock skyrocket here. And then you look somewhere and you think you found a support level somewhere right here, and you sell a cash secured put on the stock, and maybe you even do it on a red day. Because as we know, we want to sell a cash secured put on a red day. Totally makes sense. No problem so far. But there's two main things here that are a big problem. First of all, number one rule, you're breaking it. You're only trading this stock for massive premium returns. So maybe you find your level, you find your support level somewhere, and you sell that cash secured put, and you make literally a 10% return in 1 month. That's an illusion because stock ends up crashing. You think you make a 10% return. It's outrageous. It's insane. You make over 100% in a year. But what you guys don't understand is this stock has a huge rally. So let's say the stock rallied like 1,000%. This stock went up 1,000%, let's say. And you sell a cash secured put when you found out, when you think that there is a support level and the stock is down 10%. But that stock is down 10% after 1,000% rally. So that stock is still up. Plus, it is also a small cap stock. So this is a very volatile stock with a very new business model. And you just got big eyes because you saw that juicy premium. And that is the number one mistake, because you got overconfident, you chose the wrong underlying asset, your greed changed the point of view that you analyze this stock. Because if you look at it rationally, you would have seen that this stock had a huge rally. It doesn't meet the underlying asset criteria. You should have never sold a cash secured put on the stock, but you did it. And what happens? You sell it. Few days later, stock ends up absolutely smashing through your support level and goes all the way down to a reasonable level where the stock was sitting at in the past. And suddenly you sit there with your 10% premium that basically just got completely eliminated because you're massively in the hole. So, general rule for new investors, but also for investing veterans: always stick to safe underlying assets. Guys, it is not worth it to take on that risk, choose the wrong tickers, and just get absolutely smashed on the wrong underlying asset. Because if you hold this stock, and this is the problem, guys, that you understand it, if you hold this stock somewhere right here at $20, but it smashes all the way down to $7, your income from this stock is eliminated because you will not receive any premium anymore because you own it at this cost basis, but the stock is only worth $7 now. You cannot sell covered calls at $20 anymore. It's not possible. The range is too far in between that. And this is the problem. Your premium cycle is stopped. It's like you put a stick into the cycle, you put a stick into the wheel, and it is not turning anymore because it is so far away from your cost basis. So always focus on safe assets, safe underlying stocks, and always choose your strike price more conservative than aggressive. If you guys are interested in this trading strategy to generate a safe passive income, then click the link in my bio, join my community. I have a free course for you guys to check it out completely for free. I also have a paid community where I go even more in detail, and I am sharing my personal live trades on high quality stocks, so you end up not making such a bad decision like on this one. So if this sounds interesting to you and you want to check it out, click the link in my bio, join my community, and I will see you guys there.